Hey everyone, as mentioned in the daily financial news, Wednesdays are special. We have a couple of real estate experts on, and we close it out with Matt, the mortgage guy. How you doing, buddy?
I'm doing great, Mike. How you doing?
Good, man. Do me a favor. How can people get a hold of you? Sometimes I forget. I get so excited. So let me ask this. If people are in California, want to get a mortgage, I want them to reach out to you. How should they do that?
Sure. I think the best way to get a hold of me if you have specific questions is just email Matt, M-A-T-T, at mattthemortgageguy.com. If you jump on over to my YouTube channel and ask questions, as much as the number of questions as is increasing, I like the dialogue there because then it's for everybody to see and everybody can benefit from it. And there's plenty of questions on there that I've seen, input from multiple people, which is always good. It's open discussion. But then, you ask a question about self-employed on a self-employed video I made. Other self-employed borrowers want to see those answers. So
Yeah.
I encourage people to ask the questions on YouTube because knock on wood, I'm going to continue to try to answer them all.
Yeah, you keep doing that, man. You're gonna suddenly become a YouTube entertainer. You can't do your mortgage business. Watch out.
Right. Yeah. But I mean, it's fun to take an hour every night and go through and answer, 65 questions.
That's very cool. Well, again, folks, if you reach out to him and you tell him you hear from this channel, he'll take really good care of you. But let's get on to the topic at hand. And that is kind of a subtle tweak that I don't think most people really understand, right? The housing market is this big thing. Most people think of a housing market in a very myopic view because it's my house or my investment or whatnot. And what I want to really talk about is I have believed since 2010 that lenders control the housing market a lot more than people talk about because they really don't. And if a lender wants to be aggressive or tight, if they want to raise fees or interest or rates, I think lenders have far more power on the housing market. And if that's true, you should be paying attention because it could be one of those leading indicators for you to watch. What do you think? You're in the business.
Yeah, no, I totally agree with you. And maybe, power is a strong word, but it for sure influence, as lending guidelines change, the market is influenced by it. And so, whether, it's the Fed pulling strings or it's lenders, changing guidelines and how they lend and what they, how they lend and at what rate they lend,
right.
Which, the Fed can pull some strings that influence rates and whatnot. And so, those two things being pulled for sure, 100%, because people bring this up. And this is one part that I agree with when people have an issue with home prices going up, even though you can kind of show them it's more affordable than it was at a higher interest rate. Well, the argument on that side is that rates won't stay this low forever. And so, I agree to a certain extent that if we continue to see home price appreciation and rates go up, it's going to get real tough real fast.
Yes. Yeah. Affordability is the big thing I talk about. But again, lenders really have the control. And I want to I called it power, you called it influence, but I just want to throw something else out there. We saw a big change the other day. I guess it was last week's conversation, might've been the week before, where it's also how they want to deal with bad loans, right? So it's not only the lending side, but it can be on the opposite side where they, in theory, should foreclose, right? Or at least they should post an NOD, notice of default or whatnot. If they want to act differently on that side as well, that impacts housing as well, because there's distressed supply that's not hitting the market, right? So I think watching the lenders, man, is something more people should do.
Yeah, no, I totally agree. And that's the thing is like, when you simplify it and you're like, it's simple, guys, supply versus demand, then you have to realize like what directly influences the supply side, the demand side. And like you said, on the servicing side, if we're restricting the amount of homes that go into foreclosure and we're saying that like the CFPB says you must avoidable foreclosure, can't foreclose, need to do all this stuff with 40-year loans, restricting supply, and then demand, you can teeter-totter that with rates all day. Because if you come to me today and you qualify for X and then rates go from 3 to 5, all of a sudden you qualify for Y.
Well, you know what? I think you've done some math recently. So why don't we give some folks some examples? And I don't know if you have them down on a piece of paper or if you have Excel.
I jotted it down just as
fine.
I was, poking around this morning, and thinking about me and my business and my average client. And for easy round numbers, we'll call today's rate 3%. It's pretty darn close.
All right.
And somebody who's buying a house at 500,000, I'm dealing with plenty of people who are, first timers, and they're just putting 5% down. So it's funny because so much stuff out there is based on 20%. And then I think to myself,
actually, that's a good question. How many people do put 20% down? I mean, is it 5%?
It's probably more than that. It's
Okay.
probably like 1 in 5 or 1 in 4,
So
20 to 25%.
Okay. I didn't know.
But that's a whole different demographic,
Sure.
maybe well-to-do, have a gift from family or whatnot. But the average, more likely scenario is save up, have a plan, 2 people working, mid-30s. All right, we're thinking about having kids. We want to buy a house. We've saved up 34,000, 38,000 in the bank. We're going to put 5% down plus closing, have some reserves left over. And you buy a $500,000 house in California. Numbers change taxes wise and homeowners insurance wise elsewhere, but you put 5% down and you've got a 3% rate, all in principal, interest, tax, insurance. It's about $2,700 a month.
All right, I'm gonna write this down. So 500K, 5% down, 3% loan. We're at 2,700 roughly.
Roughly, correct.
All right, because this is going to get interesting. All right. What happens next when rates go up?
Well, I mean, it's not out of the realm of possibility that rates go to 5%. I mean, I was at, California Association of Mortgage Professionals had Barry Habib on yesterday. We're talking about, you predict inflation numbers to go up. Most everybody does. As those inflation numbers go up, if rates follow, a lot of people think that rates are going to go up in the next couple of months. And I'm not saying May of 2021 we have 5%, but
no,
it's possible that they go to 5% over the
time.
next 12 months.
Absolutely.
That $500,000 purchase, it with 5% down goes to $3,240 a month, like over $500 difference in payment.
Yeah, and then I don't know if you've done this math, but so that's shocking that it's that much. But what we have going on right now is we not only have potentially for rate rises, but what happens if that 500 house becomes 550? Right? We tack on, 10 grand or 10% in, equity growth or, whatever you want to call it. Then it probably, I mean, did you do that math?
I didn't, but I would guesstimate that for another 50 grand, what is it about?
Well, it's about $324 because that's an extra 10%. So just figure rough and tough 10% of the payment.
Yeah, because I think it's about $45 per 10,000. So, if that meant 200 and
all right, so 250, 260. So again, you're at 3,500. So you've gone up $800. And why is this important? It's because at an extra $800, a lot less people get a yes answer.
Exactly. And that's the thing too, is like if somebody comes to me and, working couple, has student loans, has a car payment, and their ceiling, because it's all math for mortgage qualification, their ceiling is we can fit a $2,800 payment in your debt to income ratio. So we got to keep it under 2,800. Well, all of a sudden it's not a matter of, are you willing or want to pay 3,200? You just don't qualify. You can't get that loan.
You get a no, right? Yeah.
And it's pretty drastic, Mike, when I did the math this morning, where that $500,000 purchase and let's pretend that your debt to income is capped. You can't have a payment higher than you had at 3% and $2,700 a month.
Yeah.
Less than $420,000.
Oh my God.
So,
really?
Yeah, that's like a 15% drop.
Wow. So if you play it the other way, I just want to make sure I summarize what you said. Let's just assume, so your payment, the max payment you could afford in this example is $2,700. Rates go from 3 to 5%. The only thing you're going to qualify for is to purchase a home at 420.
Correct.
Oh,
yeah. So your purchase power went from 500 to 420. And I mean, that works kind of across the board. People who have a yes answer up to 5 go to there. People who have a yes answer up to 6 come to here. And all of a sudden, less people qualify for.
Yeah. And again, lenders have so much power that we don't appreciate. I mean, just think about what we've talked about in the last month. So first off, we've already hit CFPB, Consumer Finance Protection Bureau, their change, basically fixing the exit, right? The avoidable foreclosure. But I think it might have been the week before, where there was a letter talking about Fannie and Freddie buying 7% of investment loans versus 15. And again, that is going to cause banks to raise interest rates on investment loans. So again, banks, lenders, obviously maybe federal up at top, but they can really change interest rates even specifically, right? So investment loans go up in cost where owner occupants don't, thus creating a spread, right? A bigger spread than normal.
Right, right. And I think I see that happening. I try to read, the tea leaves.
Right.
And last night, a lender sends out an announcement that says, lock your loans today, starting tomorrow. Here's these loan level price adjustments for investment properties. And it's inevitable. We talked about it. As Fannie and Freddie says, send us less investment loans and second homes. Lenders are going to adjust pricing to throttle back and have brokers send them less of that business. Then from a different lender, I saw something that said, we just lowered our criteria on FHA loans. We're going to go lower on credit score. A lender that was only taking 640 and above is now going to go down to 620. And so it might be like you said, where the powers that be say more owner occupied, less investment stuff.
That's clearly
easier here, harder here.
Yeah. Not only harder, but more expensive.
Right.
And that's, of course, if you're an investor, you follow what I talk about, it's cash flow. It's not, you don't buy alligators, right? You don't bet on appreciation in what I teach and what I follow. So yeah, more expensive means you can buy less. And especially in a rising, they could really take out mom and pop investors, right? The people that own 1 to 10, if they wanted to just raise rates, create this. I mean, if the spread goes to 2%, right? If it's 3% for owner occ and 5% for investment loans, there's going to be a lot less investment loans.
Right. Right. Yeah. And I mean, a whole nother conversation, but policies and whatnot that make it less favorable to be a mom and pop real estate investor, and, tax changes and all that other stuff just further.
Yeah. It just exacerbates the problem.
Right.
Wow. So, I think we've talked about it already, but since you're in the business every day, looking at loans and talking to brokers, what is the general feeling? You called it tea leaves. Is it just that simple? Owner occ good, investor bad today?
I think so. And when you see stuff like that happen, you think to yourself, okay, it makes sense to, in times of uncertainty, with, probably less uncertainty now than we had a year ago. If the stuff that's a little bit more risky gets more expensive, I'd probably do that too if I was the one holding the bag.
Yeah, that makes sense, right?
Right. And so I think that's what I'm seeing and feeling. And then also that, eventually we're going to see this slow increase in rates that a lot of people have been predicting for a long time, right? Where it's like, we can't stay this low this long. And I think that something I heard recently that made a lot of sense to me was Jerome Powell's only got so much time left, right? Yeah. So he's not going to take his foot off of the low interest rates and then take the blame, right? Yeah. So maybe it's end of 21, beginning of 22, but eventually I think somebody's got to say, okay, let's see what happens. Let's see if this thing can stand rates coming a little higher. Because I didn't realize, I don't really keep track of how much mortgage-backed securities are being bought. I thought when they announced like, hey, we're doing 40 billion a month, that it was 40 billion a month. Did you see that they like changed their wording where it's like, oh no, it was at least 40 billion.
At least.
Because some months they were buying 80, 90 billion.
Oh my God.
And then you think about
they are the market.
Right. Exactly. Like obviously if they're upping that number and buying 80, 90 billion a month of mortgage-backed securities, they're doing it because they have to, because nobody else is in that market.
Yeah. Well, I know one thing I wanted to ask you, because you're my mortgage expert on my weekly series, is I have never seen a 40-year mortgage quoted. I think one of the outcomes of the CFPB might be them weaseling in 40 years. Maybe it's 2 years down the line. Maybe it's a year that 40-year becomes the new 30-year. Does a 40-year mortgage actually show up on your rate sheets?
No, I don't have really, I shouldn't say I don't have any, because I've got a couple, like very few lenders that do it, and they charge such a premium for it, where I think I've got a lender who will offer a 40-year interest only on a jumbo, where it's like, hey, you really can't afford this house, but you want to try to see if you can afford it just paying the interest on a 40-year term, which is scares the heck out of me. But then it's like a 5% rate versus a lower rate. And then you look at it really close as a math person. You're like, well, wait, if I pay 3.25% principal and interest, it's not even that much more expensive and actually paying some principal. Why would I pay 5% interest only? So, I mean, I look at some stuff like that and I'm like, you've got to be a real sucker to get into something like that, where it's like, I'll pay
Yeah. So I guess what it'll be interesting, I don't know, I don't know. So it's April 14th. I don't know, by August 14th. I'm just wondering if they're going to start sneaking that into the rate sheets more common.
Yeah.
I didn't think
Well,
they were there today.
it'd be interesting since I've got this Excel spreadsheet up. So we've got 500,000 and I said, the payment goes up to 3240.
Yeah,
If
exactly.
I'm going to change 360 to 480
And see what happens.
and see if I can get the payment back down. Oh, now we're 2982. So it's wild how
So again, the rate went up 2 points, but you added 120 months, right?
right.
And the
Yeah,
payment's rough and tough, $200 more.
right.
the
So
base
it got
case.
stuck in the middle.
Yeah, well, I think that's coming. Again, I don't know this for sure. I just have this mental image that when I was younger, the 15-year, I mean younger meaning like 3 decades ago, the 15-year mortgage was like the standard most people got. For the last 15 or 20 years, the standard, again, most people got was 30-year. I don't know how I feel about it. I don't know if I'm worried, concerned, happy. I don't know. I'm kind of torn. I don't know if the 40-year becomes the new standard because again, you're paying about twice as much interest or total loan, but maybe the payment, I don't know. I just don't know how to feel about it. How do you feel
Right.
about if 40 years becomes the new 30-year? Any ideas?
I'm not necessarily opposed to it, and I think that would be in line with the how do we make it easier for owner occs, and maybe it's owner occ only 40-year loans.
Oh,
We're not going
maybe.
to
There
offer
you
these to
go.
investors, and it's only for. I can't remember who I was talking to that told me about some country that offers 100-year loans, and they just
Wow.
expect it to be passed on to generations, the debt and the home, and that's a little extreme.
A
But
100-year loan. Yeah.
but from my seat, Mike, honestly, people are refinancing into a 30 when they're 65 years old and whatnot. Like paying the mortgage off or getting to the end of the term isn't necessarily something that most
Lots
folks
of
are
people do,
concerned
yeah.
about. And so if it helps bolster home ownership and people who have, historically not been able to own a home, if the 40-year helps them do that, I think it's a good thing.
Okay. Yeah, I have to play with that a little bit more because again, my stupid mind goes, I get all of that, but my stupid mind goes, oh shit, 40-year becomes the standard, prices jump 20%. And it just eats up the difference.
Right. And maybe, rates go up and things happen and demand wanes, and then that's the new injection,
Yeah, there you go. That could be. So I guess what I'm taking from you is I guess from what your seat, it's not out of the realm to think a 40-year gets introduced in the next couple of years as an option on your rate sheet.
Right. I wouldn't be surprised.
Okay.
I wouldn't be surprised. There's a lot of stuff that I think can be done. There's like 1% or 0% down for people with good credit, but all this stuff couldn't be introduced at a time like now where there's just way too much demand as is. So
yeah, you wouldn't want to
enough people understand that at a high enough level to say, okay, no more steroids. We've seen enough steroids.
Yeah, let's let supply come back and get back to a more balanced market. Very, very cool. Any other closing thoughts on this? Because again, I think lenders have a lot more control on the front end, and as we've just seen with the Consumer Finance Protection Bureau on the back end as well. So let's see what happens.
No closing thoughts except for that I totally agree with you. When you think about the housing market in general and supply versus demand, affordability, and things like forbearance stuff on the back end, the lenders have their hands in all of that. So policies change quick. And I don't get a heads up like a newsletter or anything. It's like Fannie Mae makes an announcement and it's here. So, pay attention. And you've said it in past videos, whatever market you're in, a mortgage broker that you can reach out to and say, hey, I thought I heard this, or hey, what do you think about this, is good to have, because then you can cut through some of like the clickbait headline news and say, what does this really mean? What's really going on?
Yeah, folks, again, I'll say it. If you're in California and you haven't reached out to Matt, the mortgage guy, you are doing yourself a disservice. He needs to be on your team, whether you're an owner occ or an investor. And I remembered, how can they get a hold of you if they want to do that?
Matt, M-A-T-T at mattthemortgageguy.com. Shoot me an email. I will try to respond as quick as possible. Within 24 hours is probably reasonable.
Very cool, man. Well, I appreciate you every Wednesday. Thanks, buddy.
Thanks, Mike.